Thank you for attending today's presentation. We've got two presenters for you today, which is Stephen Goakes, our Managing Director, and Peter Tills, who's our Head of Funds Management. Just to go through the disclaimer, obviously this presentation does not constitute financial advice and you need to speak to a trusted advisor before making any investment decision. I'll hand over to Stephen now, who will talk a little bit about who Natgen is, and then Peter will run through the asset that we've recently bought in Natgen Investment Trust SP24.
Thanks very much, Caroline. I'm sorry, my camera doesn't seem to be working, but I think you've got the presentation up anyway. Thanks everyone for joining us. I thought I'd give you a little bit of an overview of the Natgen business and what we do and who we do it for. Natgen provides managed investments in the property area for clients basically nationwide in every state and territory of Australia. As you can see there, our decision making is based on measurement and analysis, and we particularly operate in areas for commercial real estate. Our first product that we deal with is our Natgen Income Trusts, which is like the SP24 trust, where we target an asset, we acquire it, and then we operate it for investors to provide them with steady, ongoing, regular monthly income. And we have a number of those trusts with assets in Queensland, New South Wales, and Western Australia currently. The second limb of our business is the Natgen Development Trusts, where we find a development site, put together a development project, and build it with the help of investor funds. And in fact, in those types of vehicles, the investors stand effectively in the shoes of the developer and make development profits. They exist in two types. For the short-term development trusts, which are usually about 1 to 2 years in term, and the total returns we get on those are in the order of around 25% or thereabouts. And then we have our long-term sort of 7 to 8 year developments where we construct the development and then operate it for a few years. The construction phase of those ones adds something in the sort of 40 to 50% uplift in unit value, and then we're showing that around 10% per annum thereafter, and that leads to a very healthy total return at the end of that time. And then the third type of Natgen fund is the Natgen Deposit Fund, which is due to be released in the early part of 2025, and is basically a cash deposit fund where investors can put their money in and make a return based on the official cash rate for the Reserve Bank, plus an uplifted margin on that. And we should have more details on that to you early in 2025. So we're in this case we're talking particularly about investment trusts and how they work. So I'd like to hand over now to Peter Tills to talk through some of the taxation and return aspects of our Natgen investment trusts. Thanks, Peter.
Thanks, Stephen. Hi, everyone. I thought, just turn the page, there we go. I thought we might just have a quick discussion about the taxation benefits of investing in property, because we've got some new investors on the line, as well as some pre-existing investors that are quite familiar with these concepts. So we've just got a couple of slides here. The first one sort of illustrates the three different types of returns that you can get from property. The main one being regular, reliable income or cash income distributions. The second part relates to actually turning some of that income or most of that income into capital, which has taxation benefits and basically means that you're pushing that sort of taxation aspect into the future. And thirdly, there is, because you actually own property, most likely property appreciates over time, and most likely you'll be eligible to receive capital growth or capital appreciation in your investment. Just to illustrate those kind of concepts, if we look at 3 different types of investments, like a cash or deposit, term deposit type investment, a mortgage fund investment, or a Natgen property trust. And if we assume you can get 5% on, say, the cash deposit, or 8% on the mortgage fund, or 8% in the Natgen property trust, and you're investing for 5 years, and it's $100,000 investment. The orange line basically shows you what sort of income you might receive over the course of a year. So 2,600, for instance, in the cash side of things versus $8,000 in the Natgen property trust. The difference is that tax deferred component, and in this particular example, we're assuming that 100% is deferrable. The return after a 5-year period, with all of those things being equal, you can see again, cash or term deposits returning about $13,000 of income, mortgage fund returning about $21,000 of income, but the property fund is giving you $40,000. And then at the very end, if we're looking at the actual property appreciation of assuming 3% per annum, the total tax return over a 5-year period, again, you've got the green line there, so 13,000 odd in cash, 21,000 in mortgages, and 38,000 in property. But we're not obviously comparing apples and with apples. We've actually got 3 different types of assets there. We've got apples, we've got pears, and we've got oranges. Each have their own features and benefits to investing in them. For instance, term deposits, if you invest up to $250,000 with a particular Australian authorised deposit taking institution, you could be eligible for up to $250,000 worth of government guarantee on your investment. In terms of mortgage funds, they're secured by property, but you also have to remember that it depends on who's writing those loans. And I won't go back to the Big Short and all those sorts of things, but it just depends on the quality of how those loans are written, what the location of those properties, etc., evaluations and the like. So you need to consider that. And then with our Natgen property trusts, you pretty much know what you're going to get because you're choosing what investment you want to invest in, and you're an equity holder or an owner of that, or part owner of that particular property. So if we then consider that previous scenario, and we're in year 5, and we think about what's been happening lately with inflation and how that's kind of readjusted how everyone looks at the world. In this particular example, we've just assumed the 3% inflation rate, not what we've seen recently. So if we go to the green line and we consider that cash over that period of time, again, has returned the $13,000. But if you look at the inflation adjustment, it's actually adjusting for that 3% inflation rate. It brings down the after-tax return to $2,677, where you lost sort of capital in that regard, versus what the mortgage fund has done of an improvement of $5,000 and the Natgen property fund of $22,000. I won't go into too much detail there. We've probably gone too far, but anyway, we'll just keep moving. In terms of how we know what property does over time, the MSCI index is actually collated against all Australian property investments from an institutional sense. So the big guys like Dexus, etc., contribute all their property data, and this information has been provided over a 24-25-year period. And what you can see on this chart is the kind of typical property cycles within that period. So we've got peaks and troughs. But what you'll see as well is that those yellow bars continue to be positive, and that's income. So income is consistent throughout that period, whereas your green bars, sort of do bounce around a bit, and that's kind of the capital appreciation or depreciation. At the moment, the capital component is in that sort of negative period, but that's why we're finding opportunities for our investors. The other point to note is the long-term average return for investors in property, and over that period of time, again, it's been 9.6% per annum. So it's pretty impressive. So I mentioned we look for. Oh, sorry, Stephen actually mentioned that we have very careful consideration when we're looking at particular assets and what we're looking for. Essentially, we're looking for mispriced commercial assets, and we spend the time on the ground looking at them and what can be done with them and making sure we've got good tenants and in great locations. We see opportunity at the moment. We favour regional convenience retail, non-capital city CBD office assets, industrial assets that have rental reversion opportunities, but we haven't quite found too many of those at the moment because they're a bit not quite as rare as hen's teeth, but we're definitely looking. Specialist assets and development assets, which Stephen also touched on. In this particular example today, we'll be talking about specialist assets because medical forms part of that, and with really good supply and demand drivers facilitating rental growth. So if we take a look at our latest offering, which is the Natgen Investment Trust SP24. This will just provide you with a bit of an overview. You might have already had a look at the information memorandum, but essentially it's a day hospital. It's a very resilient sector. We've got very favourable net lease terms, which have the higher of inflation or 5%. It's a very long lease to this particular tenant. It's a 25-year lease with 9 years remaining, and then they've got a further 5-year option. It's very well located, as you can see. That's actually a really good photo of the actual location at the on the Gold Coast CBD, and you can see the main sort of streets and roads around it that connect it very, very well. There's positive population growth, and this particular asset, we're targeting an 8% net monthly distribution with the potential for capital growth. In terms of the asset, it's a top floor stratum. We're buying that for $9.65 million. We're using $6.25 million of equity from investors, and we've got $4.825 million, which we'll be raising in terms of debt. So that sort of brings it to $11.075 million. The term of the trust will be 5 to 6 years. And as I said previously, we're targeting that average distribution paid monthly of 8% per annum. It's got a 61% tax advantaged component to it. And I think that's probably what I'd cover up there. The other point to note, Stephen, did you want to just sort of mention sort of what's been happening on the debt side of things there?
Yeah, sure, Peter. Thanks. Yeah, we've been out to the banks to raise the debt component as usual, and we've got offers from 3 of the big 4 banks at this stage, plus a couple of minor banks as well. So we're seeing very good low margins from the banks at the moment, and that's indicative of an asset that the banks consider to be very strong. And when you look at the location, the sector of the tenant, the length of the tenancy with a further 9 years to go, and just all the general factors, including the state of the building, etc. That's all reflected in the margin that we get from those banks, which is looking very strong, as I said. Thanks.
Thanks, Peter. In terms of the Gold Coast, I think most of you would know that it's located in Queensland. It's sort of considered the next big city other than the various capital cities of all the states around Australia. It's actually because of its beach vibe and all that sort of thing. And post-COVID, there's been a huge sort of movement toward the Gold Coast in terms of relocating from Melbourne and so forth. So we've got a lot of favourable demand drivers with limited supply because of the inflation side of things in this particular location. So population growth, just for your interest, over the last 10 years has been 23% on the Gold Coast versus 16.5% for Queensland. So very much punching above its weight there. The Australian government has also done its own sort of analysis via its primary health network, and they look at the future needs analysis of various populations and locations. And the Gold Coast shows up as higher than average again in terms of healthcare demand. So again, this all keeps coming back to that population growth story, which supports what we're doing here. Just a couple of quotes here from the Property Council of Australia and CBRE. Now they're talking about office having limited opportunities across all building grades and so forth. But basically what you're seeing is the PCA and CBRE, one of the biggest agents in Australia, talking about the limited supply, and it's actually forcing tenants to roll over leases. So that, again, it just shows the tight conditions that exist on the Gold Coast.
Peter, if I could just cut in for a minute, just with regard to that issue of Gold Coast and tightness of the market. One thing, particularly with medical property, also is it's generally speaking at or above the standard of A-grade office in other places. And one of the fundamental factors we're facing at the moment is that the rents at the moment for these type of assets is below where the rents would need to be to make them economically replaceable. So existing assets have a significant advantage, and that's why the Gold Coast office market is so tight, because it's not possible to actually replicate further office buildings on the Gold Coast at a cost that would allow them to be rented at current market rents, and that gives a floor on what the values are going to be on existing assets and gives substantial headroom before any new assets can come into the market, which is great for things like this.
Thanks, Steve. In terms of medical property, why we like it as a sector, again, going back to that whole growing and aging population, there's the older we get, unfortunately, the more we need medical services. There's a couple of statistics there on those charts on the right. You can see in the 80s, the percentage of the population with the orange bar that were 55 and over, and you can see how that's grown and forecast to grow, in another sort of 40 years. The other part of, because of the demand for medical treatment and so forth, that means that those particular tenants typically have stable cash flows. A lot of what services they provide is actually government funded. So if you look at that pie chart on the bottom, the dark blue is the Australian government funding, and that sort of segment on the left-hand side, the $70 billion, that's from state and territory governments. So in aggregate, it's about 72% of all funding is coming from government in terms of healthcare services. So you've got government backing, demographic tailwinds, there's low vacancy rates in these types of assets, and it provides stable cash flow. So that's really what we're looking at here. In terms of the particular tenant that we have, I don't know if you've heard of Icon Group before, but they are Australia's largest dedicated cancer care provider. they've grown globally into parts of Asia as well. And they provide very important sort of treatments for people with cancer. In this particular day hospital, they provide chemotherapy and immunotherapy to patients. The cancer rates, unfortunately, for people over the age of 45, there's a 90, like they account for 92% of cancer that gets diagnosed, unfortunately. So it's really important that we have places like this for groups like ICON to operate and service and help these people. This is just to give you a bit of a flavour in terms of the tenancy and what, sort of how the services are delivered. The asset has 35 dedicated car parks for it as well. And you saw that earlier slide that showed the major arterial roads sort of linking up around this particular property. And what that means is it's very easy for these patients to come in and receive their treatment and not have that stress of trying to find a car park or all those horrible things on top of what they're doing here. So Caroline, over to you.
Thanks, everyone. So to participate in any Natgen investment trust, it's important that you order a copy of the information memorandum, read it in its entirety, and then seek your own professional advisor advice whether this is right for your investment purposes. You then simply apply either on a paper application form or via our investor portal and provide the necessary documentation to support your application. We've got a couple of questions to be answered. So the first one, which we've got Stephen back, and he's going to be able to present to you now. So one of the first questions, Stephen, that we've had come in is, why the vendor's selling in this instance, this asset?
Yeah, okay. So the vendor is a group of doctors, group of oncologists that have been involved with some of the people that have put together ICON Group over nationwide and internationally. So basically, they've been in business for a long time, and really, they're getting towards retirement, and they're basically divesting their assets because of timing, really. As I said, the ICON Group is basically made up of doctors and oncologists nationally and internationally, with a substantial Singaporean connection as well. And hence they will continue on with new partners as the old partners get towards retirement and move on. Anything else, Caroline?
Just a little bit about your views on where you see interest rates heading at the moment and how that impacts trusts of this nature with 50% gearing.
Okay, yes. Well, it's something that I, of course, think about and talk about a lot. Sometimes I talk in my sleep about it, which annoys my wife enormously, talking about interest rates. But anyway, it's basically the indications from the market would currently are that what the various commentators say is likely to come to pass. In other words, interest rate moderation will start either at the end of this year or early next year, and it won't go particularly far. We're not going to see anything like the rates we saw in the last cycle, which were emergency low rates. However, what that will mean is that in the money market, the rates that we actually pay for our interest on our borrowings is that they will actually start to moderate soon. In fact, we've seen them come down already. From the longer rates are actually cheaper than the short-term interest rates at the moment, and you can actually even see that in bank deposits bank loans where the fixed interest rate loans have actually come down. And we're probably also seeing that moderation in terms of the of term deposits, and longer term deposits are not certainly rising as they were in the past. So all that sort of indicates a moderation over time. This is always possible to change, of course, with external shock factors, but generally speaking, the markets take a fairly conservative view on interest rates, and that's what we're seeing on the way through at the moment. So moderation in 2025, but not a lot.
And the last question is just around self-managed super funds and their ability to invest in this type of unit trust structure.
Sure. Excuse me, Natgen investment trusts are compatible with superannuation investment, self-managed super investment, and basically they're compliant investments for your self-managed superannuation fund. Simple as that.
Yep, that's it.
Okay.
Yeah, thank you. I don't think we've got any other questions that have come in. So,
all right. Thank you, everyone, for joining us this afternoon. Much appreciated. And of course, feel free to be in touch with any one of the team, including Caroline, obviously, myself, with any further questions you may have, or if you'd like to invest in this or any future Natgen investment or development trust. Thanks a lot.